This is Jay Martin.
All right, welcome back, guys. And I'm joined now by the president and CEO of Osisko Gold Royalties, Sandeep Singh. How you doing, Sandeep?
I'm good, Jay. How are you?
I'm really good. Yeah, thanks for dialing in from Zurich. I know you're on the other side of the world, and it's obviously nighttime there, but I appreciate you making the time and coming back on, getting in front of my audience. Sandeep, you know, we're deep into the inflation discussion right now with all of my guests, and you know, that's why I wanted Osisko to come on the show today, because I like your model in this environment. But why don't we start with a question that I'm getting a ton from my subscribers that I would love to put to you. And that is that if all the macro indicators we're supposed to be able to rely on that support a healthy gold market are present, yet people are saying, but it's not a super healthy gold market. What am I missing here? What do you have to say to people like that right now, Sandeep?
Yeah, it's a great question, and it's one, as you can imagine, that I get all the time as well. And I will apologize. Hopefully, we can get this interview with whatever light there is left here. It's a dark, modern hotel room I'm in, but we're getting that question. It's a fair question to ask. I think you have to look at it with a little bit of perspective, because the truth is, I think gold has actually fared okay. Certainly on a relative basis, it's done better than most things. The only thing it hasn't been able to fight is an exceptionally strong U.S. dollar, and the Fed raising rates at a somewhat unprecedented clip. So, and when those two things are happening, and really they're one and the same thing, it's almost impossible for gold to excel. The fact that it's done as well as it has, I think, is an indicator that it is working. I've been saying that gold has only been down about $50 from the start of the year. This week, maybe it's 70, 75. So down, high single digits. The problem is it went up to 2000. It's now come back to 17 and a little bit. So that's been felt a bit more so. But with the US dollar at essentially a 40-year high, there's a couple of years in that 40-year period where it was flirting higher on a relative basis. But an exceptionally strong US dollar, really only on a relative basis to everything else. I don't think the underlying fundamentals are that strong. But that's really been the only thing holding back, at least this year, the gold price. Everything else is as you say, in our favor. Excessively high levels of debt that have only skyrocketed, geopolitical risks that have always been high, unfortunately, and only get higher, obviously, this year with the war in Ukraine. But that's not the only bit of tension. The U.S. and China are also kind of on worse terms than they've been in some time. So all that's working, but the U.S. dollar has really been the latest hurdle. And frankly, there have been other hurdles. I mean, if you go back a little bit, first there was the Fed in the U.S. saying inflation wasn't real, which I don't think they actually meant, but it was the first of the many soft landings. Then it was transitory. Mm-hmm. Then, if you recall, in late 2020 or early 2021, Bitcoin was supposed to be digital gold, and the thing that's been the safe haven investment for millennia, was no longer necessary. Obviously, that turned out to be untrue pretty quickly as well. So there's been a number of hurdles, which gold has, I think, fared reasonably well with. The latest one is the U.S. dollar. But ultimately, what you have to ask yourself is, sure, can that U.S. dollar continue to strengthen forever? And I think the answer is no. And when it does start to pull back, when the Fed does break the economy, which they seem intent on doing, and not just the Fed but all central banks, I think that dollar has nowhere to go but down ultimately, and gold and the right gold equities, I think, will be the biggest beneficiaries of that.
So I'd love you to talk to me about sentiment where you're at, because we end up in a bit of a silo or an echo chamber talking to North American investors, or I do at least. And I feel like, maybe there's a bit less patience over here for the gold market. You're traveling Europe right now. Presently, you're in Zurich. You're talking to investors in a part of the world that's more familiar with the importance of gold. I mean, I love this Luke Groman quote. He says, there's very few times in history where you actually need to own gold, but at those times, it's about the only thing you want to own. And those scenarios have unfolded far more recently in Europe than they have in North America. So you're traveling right now, connected with investors. Talk to me about the sentiment towards the gold sector in Europe right now, Sandeep.
Yeah, it's a really good question, because I do think it's quite telling. I think it's a bit of a, frankly, leading indicator for maybe what the rest of us in North America will be going through, because whatever we're facing in North America, it's doubly worse here in Europe.
Right.
the inflation we're feeling, it's worse here from an energy perspective. Um, the worry of, what is energy going to cost you? Or are you going to be able to afford it this winter, depending on how tough the winter becomes? The thought process of, what the right thing to do in terms of Russia is with sanctions, but can you afford to do them? All those things are kind of being discussed in real time. And I think the output of that is a group of people, if I'm generalizing, that understand the need for that safe haven investment. Their currency, if you're talking about the euro, has been crushed on a relative basis. So they've already felt that sting of the fiat currency not working in their favor. So they're looking for, how do I protect against this? So I think it's something that's definitely resonating. We're catching up with investors that we haven't been able to see, in 2.5 years, really, for the most part. And others that are new to us. So certainly people that understand the gold market, understand when it works, and frankly, as you said, when it works, it's really the only thing that works. So I think it is a bit of a leading indicator of what some of the rest of us need to do with our portfolios.
And it's highly possible that we're just beginning to see the early innings of an inflation cycle. If you think about the energy crisis in Europe, if energy continues to become prohibitively expensive on that continent, that means economies like Germany will eventually be unable to produce the goods because the energy they need to do so, right, will not be available to them. Those goods don't make it to market. The trickle-down effect is just increasing global inflation. And so, how do you speculate about the future of inflation, Sandy, from your perspective? Let's maybe zero in on the mining business a little bit, which is super intensive in terms of, energy costs, labor. So, do you have a forecast there? What are your thoughts?
Yeah, look, I don't have a crystal ball. All I know, and I try to keep things simple for myself, and when I talk to people about it, all I know is, inflation hasn't been 8% in my life, either personally or in the mining, the mining sector. In our business, it's the gold royalty business, we're unaffected really, or largely unaffected. But in my personal life, I don't think my costs are 8% higher this year than last year. They're 25, they're 30, they're 50% higher. It depends on what you're talking about. So I think those numbers are biased. Obviously, the calculations are biased to not freak people out, but certainly all our lives are costing more. In the mining sector, it's even worse. As you said, mining is incredibly labor intensive. It's incredibly energy intensive. It's very capital intensive. Those things don't change quickly. I think the answer to your question is those items, those issues are deeper, and they're broader than I think most people would want to believe. So I do believe we're going to be dealing with inflation for longer. I don't think we're going to get anywhere close to the 2% target for a long time. I don't fully believe that the central banks will have the resolve. When you start to see, Powell use words like pain multiple times in his Jackson Hole speech, that is you better believe every word is scrutinized before it's used. They had the thesaurus out, and they chose to use that word multiple times. I think you have to listen to what they're saying. What they're telling you is they're going to push us into a recession, but I still don't think they can get there. So in the mining sector, the snapshot of that is, these are big operations. They're not easy to pivot. I use the analogy of an aircraft carrier. It's very tough to turn. You're building assets, you're building mines, over very many years. You can't exactly stop once you've started. You can't trim your staff. If labor goes up, you got to get the output out. So I think in the mining sector, unfortunately, some of our partners and just people in the sector are going to be dealing with mining inflation. That's going to run longer. It's going to creep into their margin. The good news is, I think, the right businesses, certainly most of our partners are still making good margins. I hope they continue to make very good margins, certainly better than they have for years and maybe decades. I think the gold business is a much stronger business right now. And the only thing lacking has been, the momentum has been against us. But ultimately, some of these businesses are healthier than they've ever been. And then unfortunately, like us, cheap, almost as cheap as they've ever been.
Well, unfortunately for you, but not for people like me who are looking for smart allocations or smart homes for capital. And, I want to talk about this because it's been very hard. And a conversation I've had on my channel frequently, what I always have is, where are you putting cash right now with my guests? Where do you see value? And that's been a really hard question to answer for about 2 years. You could say that the resource sector has been crushed, and over the last 18 months, it's looked really cheap, but it's tough to know when that's going to turn around. I mean, I got to point out, you guys put out record numbers in Q2, right? Record gold equivalent ounce deliveries and record cash margins. I mean, this is your environment. This is when Osisko really shines. And I feel like the story's just getting started because of the pipeline you built. So can you elaborate on the news, recent news Osisko just put out? Open the kimono for my audience a little bit, Sandeep.
Yeah, happy to. And before I do, maybe I would say, frankly, I agree with you. Like we look for value in this market too. I mean, remember, we're a financier of the sector. The fact that their CapEx numbers are going up, the fact that equity markets are now largely closed to most people. This is when we deploy the most amount of capital and hopefully get the best deals possible. So again, before I describe what's going on specifically for Osisko, the royalty model is one that works in all parts of the cycle, just works differently. And after a couple of years of me telling you, I think pretty consistently, that the market for growth was too expensive, I think we're now getting into a period where we might actually get some value in the new growth side of things. Otherwise, like you said, we had, the wind is really at our back operationally. We had a record Q2 ounces delivered to us and margin derived off those. So again, we are, as a gold royalty company, we are the inflation protection, right? Both by virtue of our business model, but also the commodity that we're in. So this is absolutely when we shine. Off the back of that Q2, we're expecting a much stronger, a record second half of the year, but not wishful thinking, but just based on two of our core assets ramping up. One finishing its ramp up, or hopefully finishing its ramp up from initial production a year and a half ago, or a bit longer. The other going through an expansion that they're just tying in and ironing out the kinks on. So a record Q2, hopefully a much stronger second half, even with gold prices staying at these levels. Hopefully the most amount of cash flow we've ever made as a company, and all that is coinciding with, as I said, essentially historical lows, absent a few little blips here and there in moments in time. The asset quality is exceptional. The upside is exceptional. The inflation protection matters. And as people decide, for whatever thesis you hold, and I'm sure your guests and this inflation kind of segment are going to have a lot of different reasons, to have some safe haven portion of your portfolio. So whatever thesis you subscribe to, I think the gold royalty business is probably the best way to do that, because we don't have we're not going through some of those struggles that our mining peers are. And I think you saw that in Q2. We put out a record Q2. Most mining companies were off significantly. So this is our moment, and I do think ultimately the U.S. dollar will have some chinks in its armor. And when it does, and you saw even glimpses of that a week ago, where the gold dollar on a relative basis, the basket underperformed. Maybe it was 1%. Gold outperformed by 1%, but the equities were up 3 to 5. So that's the torque that you get when things start to move, and I think that's going to happen at some point here in the near future.
Yeah, because that's the big variable right now. We could look to gold producers as a great bet, and I believe they are, and I'm allocating capital that direction. But the variables are, like, I don't think we've seen peak energy inflation, not even close. I think it's going to really hit hard this winter. And the labor shortage is going to eventually lead to wage inflation, and those two costs contribute to the cost to pull the gold out of the earth, right? Which is what your business model is built for, right? It's insulated against those variables, right? That's the whole value behind a high value royalty business. Now, yes, record numbers in Q2 without two core assets at full run rate. So that's great news for the future. Can you shed some light on those two core assets, Sandeep, in terms of time horizon, and maybe elaborate on what they are for my audience, please? And thank you.
Yeah, sure. I'm happy to. So what I was referring to, one was Victoria Gold's asset in the Yukon. That's the Eagle Mine. And really on that one is two things. One is it's continuing its ramp up to get to full steam, and that's taken it a little bit longer than anyone would have liked, but it's making methodical progress on that path. The other is to remember is that mine doesn't process ore for the 3 coldest months of the year, which happen to be obviously the first quarter lingered into the second quarter. So they naturally have a stronger second half than the first half. So that plays, both those impacts play in our favor. The other is the expansion that Capstone Copper is doing on the Mantos mine in Chile. It's a significant expansion to go from about 4.3 to 7.2 million tons per annum. They've said Q3 is the quarter where they think they'll break the back of that. And they're already doing significantly well. Getting to their run rate and the recoveries from time to time. The key now is to steady that out and do it on a regular basis. So they've guided getting there in Q3. So 2 important assets for us. The rest of the portfolio, and they did fine. They just will do better. And the rest of the portfolio is doing exceptionally well right now, obviously anchored by Malartic. And the good news that there just doesn't stop coming from Agnico and Yamana, and obviously Yamana is the subject of a merger discussion with Goldfield. So we might end up with 2 mega companies, 2 senior companies sitting there sharing our flagship assets. So no, the portfolio is doing exceptionally well. The upside is there as well. And again, you were talking about ways you can play the gold sector. Certainly, you can buy the physical. You can buy an ounce of gold or what have you, and then it remains an ounce of gold, and you get the price volatility, but none of the risk. You can buy the mining companies. You perhaps get more leverage, but I think for the foreseeable future, that leverage may work against you because of all the reasons we've talked about. Or you can buy a gold royalty company like us, where we are significantly safer because of the geographies we're in, because of the asset quality and the partners we have, the business model itself, and 1 ounce can turn into materially more, and you get that upside for the sake of investing as well. And one example of that is, we've talked about this before. We had 1.4 million meters drilled on our behalf by our partners last year. We expect similar types of numbers this year when it all plays out. That's an exceptional amount of upside. That drilling by our partners replaced the ounces that were pulled out of the ground to our benefit last year, and then some. If you add all the category in the reserve category, if you add all the categories of ounces, it was multiples. It was replaced by multiples thereof. So no, it's a good time to be us. Those record cash flows, we'll pile up. We'll use them smartly if we see value to add external growth onto the organic growth that we already have. And ultimately, we're not overly fussed. I mean, obviously, we'd like our share price to be as high as possible, but if the market is swinging in as volatile a way as it tends to do right now, and we're making more money than we have before, we're happy to take that cash flow and plow it back into buying more exposure to our company and our assets, given the runway we see in them. So I think things will turn around. I think in the meantime, we and other companies in the gold sector offer exceptional value, and those things when they spring, they move pretty hard. I think back to where we started the conversation, everything that's been happening, I think the analogy I've been using, and it's working, so I'll use it again. I think it's all just been loading that spring that wants to kind of break loose. So right now it's the US dollar that's holding us back. We'll see if there's another hurdle after that, but eventually the spring does let loose, and you want to be positioned ahead of it, not afterwards.
Yeah, I'm with you. I'm glad you mentioned the Malartic mine, because people who are familiar with Osisko obviously know, but anybody who isn't, it's worth starting there, right? The 5% net smelter. It's the best royalty in the business, right? And as that core asset for you to build upon, really, really adds so much value to Osisko's model. I'm excited to see what the Eagle Mine can do. We've had John McConnell on the show a handful of times. So my audience is very familiar with Victoria Gold and what John's up to. And the pipeline is important. The indirect access to 1.4 million meters of drilling. Did I understand that correct? Yeah, that's
in 2021 alone. Yeah.
In 2021 alone. Yeah, the indirect access to probably the biggest drilling program in the world collectively, when you think about it like that. I like that. It's exciting. So you're back in hunting mode, right? At these depressed prices. That's exciting. But in no rush. You don't need to be. Anything you want to leave my audience with, Sandeep, before we wrap this up?
No, look, I think we've covered it. I mean, we're a pretty simple story right now. It's the assets are performing exceptionally well. In the most case, they're getting stronger. They're long life assets. They're getting longer. They're big assets. They're getting bigger. They're in great jurisdictions, and all of that's going to matter. Ultimately, the fundamentals will matter. You can ignore them for a period of time, and there's always a thesis for why gold shouldn't work. But I do think the world I'm living in tells me this is when I need a safe haven investment more than ever before. And I think ultimately we'll be right about that collectively.
Yeah. I mean, it's funny. There always seems to be a gold bull market right around the corner. It's like just almost
Yeah,
there for a decade.
sure.
And, I ask my guests the same question when I wrap up each interview is, where are you allocating cash right now? Right. And, waiting to hear that consensus, and I'm starting to see it. I've mentioned this a few times in recent conversations, but I'm starting to see that consensus among sector agnostic money managers that they're finding reasons to have a non-zero gold position. And maybe they had a zero gold position, 6 months to a year ago for the previous 8 to 10 years. And now all of a sudden they are understanding they need some sort of a non-zero position. And that means something different for everybody, right? Different allocation, but that consensus, that's very important. That's what I spend a lot of time paying attention to, because I try my best to get the most diverse guest list I can. And then when you start to hear consensus around one thing, you're like, that's the avalanche of money right there, right? Everyone's putting a little bit or a lot or a medium amount towards one thing. And that's when things really start to move. And we're seeing that at the central bank level. I mean, they've been leading the way for the last 8 years, subtly, and then less subtly today for sure. But the allocations to physical gold, the decoupling of the paper market to the physical market, like there's a lot going on right now in the gold sector that I haven't seen before. And I'm no veteran, right? 10, 12 years here, but like, it's exciting to me. And I'm excited by your story. Obviously, I'm happy to share that enthusiasm with my audience, because I think it's a smart home for cash, man. And it feels good. To have.
Yeah, we would agree. We would agree. We appreciate your enthusiasm. And I would say, to your one last point, maybe what you just said, it's so underheld, like even, by so many different people. So even, fractional additions make such a massive difference. And right now everybody's, it's gone so bearish and everyone's moved away so hard that, that even a little bit of incremental money for this sector will go a long way. I think it is going to be a sector where you're going to have to stock pick, though. Not everything's going to work the same way. Be it, for CapEx blowout reasons or OpEx blowout reasons, or geographies that maybe don't quite work, in this market when some of the stresses start to kind of take over. But certainly we hope we provide something that's diversified and that your listeners see value in. So thanks for checking in on us.
Thank you for dialing in late at night from across the world, Sandeep. I appreciate it, man. No, I do. And look forward to next time. All right, man. All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.